Great to have you on today. Look, the reality is inflation does remain stubbornly high in Turkey, but this decision was a shock given the trajectory that the central bank had been on and also in the aftermath of the leadership change that we've just seen. So walk me through this. Is this policy or is it politics at play? What's going on?
I would say both. It was a courageous move by the central bank. And in order to truly appreciate the meaning of this, we have to kind of understand the historical perspective and the local dynamics. Well, from a historical perspective, our central bank has been under chronic pressures by the government and to keep the interest rates lower and to stimulate growth. In the last 6 years alone, the central bank governor has been changed 6 times. Usually the hawkish governor is replaced by the dovish one. And on top of this, we have the local elections coming in about a week from now. So in this background, being able to increase interest rates by 500 basis points has an important meaning, not just for disinflation purposes, but also it has a signaling value, a symbolic meaning, because it kind of tells the markets that I am the central bank and here I am. I am not going to deviate from the optimal policy. And if I need to hike interest rates, I can do it even the week before elections.
Yeah, absolutely fascinating. So, Selva, what do we need to know about forward guidance here? Do you think there are more rate hikes to come, particularly following the elections?
It looks like it. When we look at the central bank's policy meeting, the meeting announcement, they do note that if it is necessary to tighten more, they won't hesitate in tightening more. And if we look at the justifications, yes, there might be need to tighten further because at the moment in Turkey, the inflation rate is 6 to 7%. And yet the central bank's year-end target is 36%. So we have a long way to go. And the central bank governor has been rather clear with the forward guidance and noted that if the monthly seasonally adjusted inflation exceeds 3% on average until the first half of the year, then it is going to push central bank off track. I think that was one important reason why they considered a rate hike yesterday, because the February number came at 4.5% on a monthly basis. And after you do the seasonal adjustments, it is still higher than 3%. So that and the depreciation in Turkish lira, which accelerated in the last 2 weeks, were important reasons. Now, with the move that the central bank considered yesterday, it kind of told the markets that if you dare me to take action, I can take action. So that might calm the markets down. I think it will be appreciated by the markets that the central bank is there to defend the Turkish lira and hence eliminate the spillovers or limit the spillovers from the foreign exchange depreciation to the inflation rate. And that might therefore reduce the need for further rate hikes moving forward. But we have to wait and see, of course.
Right, so watch this space. And perhaps the new governor taking a sledgehammer to inflation here and making his mark, saying, I'll do whatever it takes to bring down double-digit inflation. Selva, just on another issue here, what we see is the central bank really fighting this battle and trying to strike this balance between, one, fighting inflation, but also maintaining economic growth, which is critical on the ground. How do you think this rate hike is going to impact investor sentiment, though, towards the Turkish economy and the lira? Is it going to attract more inflows, or is it going to encourage capital flight, which has been quite a significant issue in Turkey as the new economic management team tries to hit reset and encourage more foreign direct investment?
I think this move and the overall determination of the central bank should encourage capital inflows. However, do I expect a trade-off between disinflation and growth? Yes, I do, because we are talking about a very serious disinflation program, taking an inflation rate that has been at high levels, high two-digit levels for the last couple of years. And we need to reduce it to first 36%, then 15%, and then to single digits. And there is going to be a better medicine. we cannot lower inflation and maintain high growth rates at the same time. The only condition would be if there are strong capital inflows. But in an environment where central bank credibility has been destroyed to a large extent, and where the overhanging question about whether the existing policies will be sustainable or not, it won't be easy to eliminate those question marks. And therefore, so far, we haven't seen sufficient capital inflows proportional to the extensive rate hikes by the central bank. Well, the only way to get rid of those question marks is to continue in the route that you have started and keep increasing interest rates more until the markets are finally confident that the central bank is given political independence. I do think that the capital inflows will accelerate. And I also think that even if capital inflows don't come, the central bank is determined to slow down the economy and do what is necessary to lower inflation rate.